Hey everyone, it's Tim Talks Finance, and today we got something big to talk about, which is interest rates. This channel is all about interest rates, which that really gets determined through the bond market. So I want to show you something that I thought was troubling today. When I came home and I saw it, I read this. This is from the FOMC meeting. They had this meeting on September 21st and September 20th. The minutes just got released today on October 12th. If you want, I'll put a link down in the description below. You guys can check them out yourself. The markets went really crazy today, and I don't think that they've read this thing right, or I'm not reading it right. I don't know. But I'm going to show you guys what I read. This is right from them on page 3. I'll also put a link down in the description below if you guys want to check out this the Fed minutes yourself. But right here, you see where it says, the markets for Treasury securities and agency mortgage-backed securities, that's what MBS stands for, continued to function in an orderly manner, though liquidity conditions in both markets remain low, reflecting an elevated interest rate uncertainty. Okay, guys, this is scary to me, and let me explain why. I don't think anyone's really reading this right, because a lot of the message did seem like he was very dovish compared to the last couple meetings where he just sounded, the voice was hawkish. So I don't know if people are misinterpreting that or if I'm just misreading this, but if they're right and the market for Treasury securities and agency mortgage-backed securities, they function orderly today, but if liquidity is a problem because it's low in both areas, this is going to be a problem for the Main Street. Okay, this is going to be a systemic problem that we need to make sure that you know, the Fed, I hate to say it, guys, but we just need to end the Fed. They also mentioned that they are coming up with a CBDC. I mean, they didn't really call it that. I think they call it Fed Plus or something like that. But they're coming up with a CBDC in July of 2023. So anyway, I diversified all my assets into physical assets that are good for inflation, that I know I can take with me if I ever need to go anywhere, you know. So anyway, guys, why would this be a problem? Well, let me explain. Since 2008, the Federal Reserve has been the biggest buyer of both mortgage-backed securities and treasuries. Treasuries, they started buying them, I think this is in 2020 is when they started buying the treasury to control that long end of the curve. But they were buying mortgage-backed securities very aggressively, okay? Now, I know that when these guys go into the meetings, there's like a lot of guys, they've got these Harvard PhDs, and they're super educated. Like they could read and stuff like that. I can't do that, but whatever. Like, here's what I'm going to tell you though right now. This right here is telling me that there's no liquidity. So when the Fed goes out and it tries to raise money, which is what they do by issuing treasuries, they're asking for a loan and they're selling it, and liquidity comes from other, you know, countries usually. And they'll come in and say, hey, we'll buy that mortgage-backed security from you, or we'll pay this much for the agency treasury. And see, most countries do a lot of business that's denominated in US dollars. And so with that being said, the US dollar has skyrocketed against other currencies, causing such a big gap, a big widening from the emerging markets and the developed markets to us, that it's actually quite scary. So anyway, I just wanted to cover this with you because tomorrow could be a really, really big day. If that CPI number comes in at 8.1, exactly, it'd probably be a pretty calm market, but 8.2 or higher, and this market is gonna tank. Okay, and I'm talking bond market and stock market. If we come in with a headline number of like 7.8, then yes, this market will rally. But I don't think that's where it's gonna be, because PPI numbers came out, which is producer price index, right? And when the producer price index, which is the person manufacturing the product, they can't go down on their costs, what do they have to do? Eventually they have to raise them and pass them on to us. So when PPI numbers are showing that they're going up, then inflation is definitely going to be going up again. And if it's not this report, it definitely will be on the next CPI read. So anyway, guys, I just wanted to cover that because I don't want anyone to think that, hey, we're going to automatically go from 6.7 or wherever we quoted you guys at to, you know, some crazy interest rate of like 2.5 or 3. And I know there's a lot of ambition in the market, people saying the Fed's going to step in. They never let us down, but I think this time they need to let us down. They need to sell off these treasuries. They need to sell off these mortgage-backed securities, and we're going to take a big hit on interest rates for a while. But we're going to need to do something to get into a correction mode, because the Fed, they've just done too much for too long. All right, guys, hope you guys enjoyed this content. If you did, consider liking, sharing, and subscribing. All right, we'll see you in the next one.